All right, well, welcome everybody to the January 2020 edition of the Roundtable. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I am joined here by four of the best investors and, more importantly, best friends that anybody could ask for. Kim Butcher, I believe, is still in Florida these days. Is that correct, Kim? Oh, she's probably muted herself already. Trying to be a good guest.
Yeah, I did. I have accidentally.
Sounds like everybody's headed your way pretty soon. Also joined here by Ken Cavolo, our champion investor from the mid-Michigan area. Good evening, Ken.
Good evening, Mark. Good to hear your voice.
And I threw the picture of us in Chicago with huddling with one of our fellow knights at that in Wheaton. And Cy's taking a break from his scouting and as a baseball fan. Good evening, Cy.
Good evening, Mark and everybody.
And we are joined by our world traveler, our globe-trotting friend, Hugh McManus. It's a fairly current picture of Hugh on the cover slide. Good evening, Hugh.
Good evening. I shaved for that photograph.
Excellent. Nice tie, too.
Thank you.
Really, what all of these people have in common is they've been doing this for a while. They practice the philosophies and methods of the modern investment club movement. And as the slide says up at the top, what this is all about is it's a monthly series going back to July 2010. And we had never missed a monthly meeting until the most recent month when I had to step away for a few days. And we apologize for that, but we're back on track and looking forward to wrapping up our 10th year come July this year. But it really is all about discovery, vision. We love to think in terms of vision and imagination, and just this notion of discovering companies that are persistently excellent. And that really is what the whole thing boils down to. It's a little bit of a being at the top of the mountain, and we need to be careful about celebrating, but we also have to respect that this is challenging, and what this group of people has done over the last 9.5 years is actually fairly exceptional. We'll talk about that in a few minutes. But really fascinating results achieved with some different twists on investing, everything from fairly conservative to somewhat speculative. And it has sure added up to something special, and I just want to thank all of you. So before we get started, just our monthly reminder that no investment recommendation whatsoever is intended. This is all about education. As I just said, it's about demonstrating a method of discovering opportunity and embracing freedom. And so everything is done here for demonstration and illustration. And we might mention companies that we own, and we'll try to disclose that when we run into those situations.
Mark, I'm going to interrupt for just a moment. Your voice is cutting in and out. Is there something happening with your cord or your feed that you know of?
Nothing different other than the internet has been a bit bumpy here lately.
Okay. We can understand most of what you're saying, but you are cutting in and out a little bit.
Well, that's a shame because I'm in the zone, and it's a shame if I lose any of this. Yeah,
right.
Just kidding. Now, if you have a friend or a family member that would be interested in getting a reminder, Natalie would be happy to send you a couple of reminders of when these events happen. We do these roundtables. We do a few other educational topics on the topic of investing. Just send an email to ncavola1@comcast.net. And again, if you have follow-up questions, we do Q&A at the end, but if you have follow-up questions, if you'd like a copy of slides, or just simply want to follow up, Mark R at manifestinvesting.com. And as I stated before, if you want more information or if you want to enter the Groundhog Challenge for 2020, be happy to put that on there. All right, here's the agenda that we've been using for, like we said, almost 10 years. Again, welcome, especially if you're new. We try to keep this fairly informal, but we are going to pack 5 of our favorite ideas and some analysis into this session, so we do have to step pretty lively through everything as we go. But welcome, especially if you're new. And when we do the audience poll that you see down there in point number 9, even if you're a newcomer, you're invited to make a selection from among the 5 presentations. We'll talk briefly about performance, a little bit of long-term perspective. We don't really have any true portfolio challenges to our tracking portfolio tonight. We'll show some of the companies that are on the hot seat, but nothing terribly hot tonight. And there you see the 5 selections: Maximus by Ken, Middleby by Kim, VMware by Cy, Skechers by me, and Gilead Sciences by Hugh. Again, we do a poll when we're done with the 5 presentations, and then we will open it up for Q&A. Just a quick reminder, we've been doing this for 9.5 years. We are just here to share ideas and again show some analysis and techniques on the discovery and the analysis of ideas. We do encourage non-core selections. One of those non-core selections that we'll talk about briefly here tonight is Ardelyx, that has basically fueled our Knights of the Round Table entry into this year's Groundhog Challenge to the top of the leaderboard, because it's only gone from $2 to $7.50 over these last few months. That's had quite an impact on a lot of groundhog participants in this year's contest. Our goal is to beat the long-term market as measured by the Wilshire 5000 by 5 percentage points over the long term, and you'll see, we'll show in a minute that we are doing that. We do like to see a majority of the stocks that we pick actually outperform the market after we pick them. But I thought we might take a time out just for a little perspective. This is the time of year when we basically talk about, you know what goes on from year to year, and this happens to be one of Ken Kavula's favorite histograms, so I'll let him take it away.
I love this particular chart, and there's a couple of accompanying charts that go with this histogram. That's just a fancy word for a bar graph. What this particular graph is showing are 1-year returns on the Wilshire 5000 or on some of its predecessors, if we're measuring from before the Wilshire 5000 was in place. If you notice, we're starting right at around 1940. I think 1941 is the first block on the chart, and it's just showing 1-year returns. Now, that leaves us with a fair number of negative returns on this 1-year basis right here. You can see that the first 4 bars on the bar graph are all negative, 2008 being the worst year, in the last 70 plus years to deal with, and 1974 being almost as bad, along with 2002. But when you start to put these yearly figures together and start to redo your histogram into 3-year blocks, and then into 5-year overlapping blocks. In other words, a block that would say 1950 would really stand for 1948, 49, and 50. And a block that would read today would really stand for the would read 2019 and stand for 2017, 18, and 19. When you start to put them into 3-year blocks, you begin to notice a very unusual fact that the negative times begin to shorten considerably. And when you put them into 5-year blocks, you find that you only have a single 5-year negative span when the market was negative, and that negative value is less than 2%. A short way to say what I've been kind of droning on about here is that there's hardly ever a long period of time in recent history, the last 75 years, where we have more than a 1 or 2 year period that's actually negative. Now, if that impacts you right at the time when you're retiring or right at the time when you have a financial emergency, it can be devastating to a portfolio. But for most folks, there's time to recover no matter when it is that you're looking at your nest egg. There's time to recover and to actually make some positive return. I think what I'm going to do, Mark, is I'm going to bring my charts from the Standard & Poor's. They happen to be part of our jargon class that we teach to our beginners at convention. And I think I'll bring my set of charts and we'll look at them next month.
Okay.
And we'll actually show how the negative returns reduce themselves. But this is an interesting thing. I told Mark I was talking about this to my barber. Yeah, I still go to the barber and he makes motions about cutting what little hair is left. And I certainly think he adds 15 minutes to it just to make me feel good. But when I was speaking to my barber about stocks this time, because he's very interested in stocks, he asked me about negative return, and I was trying to explain this graph without the graph being there. So I think what I'll do is I'll copy these off and bring these to Tom the next time I take it to cut my little fringe of hair when I go. That'll be in another month or so. So thanks for putting it up here, and I think it's a really interesting kind of a graphic to begin an investment club meeting with sometimes, to sit and kind of absorb what a graph like this or a histogram like this really means.
Yeah, one of the things it says to me is that in any one year, anything can happen. You know, those blocks can land anywhere on this chart. I mean, look at what happened just in December 2018 and how much damage was inflicted just in December in that fourth quarter of 2018, and we ended up on the left-hand side of the chart. Look at how special 2019 is in terms of where the blocks are landing. Any other comments, Hugh? Or
What do the different colors mean?
just
Yellow, green, and red.
the yellow
different
is since the year 2000. The green is the boom years of the last 5 years of the 1990s.
Right, okay.
And then the red is just obviously everything since 1941 up to that point. See, the yellow ones are just the last 20 years. I find it kind of compelling the way that if you try to visualize where the middle of those blocks are, it's somewhere, you know, right down the middle of that chart. You know, somewhere in that 10 to 20% column. So good, clean fun. All right, we'll press on. So how's the investing roundtable tracking portfolio done? Here's the answer to the question going back, showing the months ever since year number 3. We currently stand at a rate of return of 17.9%. That's versus matching investments in the Wilshire 5000 that would have delivered 12%. 17.9 minus 12 gives us that relative return of 5.9, and that's the number that is plotted on that on the y-axis of this chart. So you basically have the years of operation on the x-axis, the how is it done versus the market on the y. Our ambition, and it's a fairly noble and generous ambition, is to beat that red dotted line, which is beating the market by 5 percentage points. And we are clipping along at, again, 5.9, almost 6%, and we are seeing about half of our picks beat the market. So again, this is a moment for respect, admiration, and just a quiet celebration, and hope that we can continue. I think it says a lot for the method and the potential that we all have to experience as investors. Any comments?
We'd be glad to send this graphic and any of the graphics in tonight's performance to the directors out in Puget Sound, who very politely but very firmly told us that you can't do this. Back in November when we visited, we heard from a number of directors that this goal was almost unachievable, and they never saw anybody that could do it over a period of time. Well, we're showing that you can do it. You can beat the market, and you can do it for a relatively decent period of time. So the graph is there. We can provide all of the data that goes behind these little dots on the X and Y axis, and we can show you that our relative return is exceeding that goal set by George Nicholson way back in the 40s when he suggested that a well-run investment club has the opportunity to beat the market by 5 points.
Absolutely. All right, we're a little bit tight on time, so we'll just kind of scroll through. I wanted to give the audience an update on the portfolio itself. These are the top 20 positions by asset side or asset size or total assets. Our largest position is in Apple at 37,734. What the legend at the top is for is to basically tell you how many times Apple has been selected. And you can see that it's been selected 8 times. Let me get my pen working. Apple's been selected 8 times. So every time a knight or the audience or a damsel has selected Apple in the last 9.5 years, we invest $1,000 into it. So $8,000 invested in Apple is now worth $37,735, basically. So you can see from top to bottom, the most frequent selection has been Cognizant Technology. That's one of Cy's favorites. I think he selected most of those 15, but that's what the key is for. And we're just fascinated from time to time, just looking at some of these like global payments. Cy selected that 9 years ago, the one-time selection, so $1,000 is now worth that. And
that's also, you got to remember, TSS was bought up by Global Payments.
yeah, so the company is transforming and probably improving. An already strong company. So any other comments on this, Ken or Hugh or Cy?
Kind of numbers to marvel at, Mark, the power of compounding and everything that goes into that.
I agree. I mean, Universal Display has only been selected 4 times. So good, clean fund. So these are the 20 largest positions. If you want to look at, I believe there's about 60 active positions. You can use that click link at the top of the chart to actually review all of the selections down to even the ones that have just been recently made and with just 1,000 invested in them. All right, one of the things we do like to talk about is in the realm of kind of emulating some portfolio management. You don't typically do this so much for a tracking portfolio, but we want to adhere to some of the types of best practices that we believe are in managing a traditional portfolio. One of those things is to monitor for the companies with the lowest expectations. And in this case, the lowest projected annual return, the lowest return forecast. Right now, that honor belongs to Skyworks Solutions and Merit Medical Systems. Again, these are all pretty good companies on this chart. They just happen to have the lowest return expectations. I'm going to go ahead and suggest that Merit Medical be removed from the portfolio. That's one of my selections. I just don't see them doing some of the things they said they were going to do, and I'm being polite. And I think we'll take my 8.5% gain and run for the hills. So we're going to go ahead and sell. I mean, it was down 20%, and now it's positive, so I'm just going to say thank you. And remove it from my field of vision. Any comment? Go ahead, Ken.
I will make the point, Mark, that personally and in 2 of my clubs, we've done a fairly deep dive into Proto Labs and have decided that there's not a whole lot left there to force us, to move forward. And we removed Proto Labs from 2 of my club's holdings, and I've sold it personally as well. So it might be something that we would want to consider jettisoning. It's had I don't know how many times it's been selected, but it certainly has a par that is below average right now.
Yeah, it's been selected 3 times.
3 times, so we would be harvesting $1,000 or so. But
yeah, we've had a decent run with it, but nothing spectacular. Well, hearing no objection, we'll go ahead and throw that one on the pile too.
Yeah, and I would just, I concur with that. I don't follow Proto Labs, so I yield completely to what Ken's analysis is. But again, using the manifest tools, we're at all-time highs in the market. It's not a super strong grower, though not terrible, as Mark just circled. But notice financial strength of 78, which is acceptable. But again, at this point in the market, I would be tending to want a little bit better. And again, you've got on the high side of good quality, but not excellent. So all of those factors, in my mind, support going ahead and taking Proto Labs off the table too, because of the low return. I mean, if it were a strong return, I'm not. None of those factors are bad enough to sell it, but
What I like, Cy, is that we've been working pretty hard in the last year to get our sales growth in our portfolio average to push it
Right.
up near 12, and we've pushed it up to 11.9, and these two deletions just help us, nibble away at that goal of getting it up at 12 or so, where we think that the sales growth should be to generate the kind of returns that will keep us above that +5.
right.
Okay, well, don't need to belabor it, but we'll take care of those and keep pressing on. One of the things we did promise that we would watch after a few months ago, we talked about the relative strength index, and this one has been pretty cool. I believe, Cy, you picked this just a few months ago, Texas Roadhouse, and it has been
Yes.
sizzling.
Very good, Mark.
Steakhouse sizzling. I got
Tasty.
it, Mark.
It's a tasty. It was a tasty pick, is what you're saying.
So anyhow, there's no reason to sell this one, but this is just an example, like you said, Si, with the market really being red hot. Sometimes we can discover opportunities to sell. I think this one still has a par of about 10%, and you're up 30 or 40% in a few months. And no, it's not time to sell it, but if it gets up above 90 on the relative strength, maybe we do have a discussion about that down the road. So
Now, Mark, we've talked about these. We've talked about these moving averages crossing. This is a golden cross, right? Where the red line is crossing the blue line in the upward direction.
Yeah, this is a really good condition right here.
Okay, yeah.
And they do tend to come true every once in a while. So we'll just be mindful that this thing has been, as I said, sizzling. All right. And with that, we'll go into our stock presentations. Let's go ahead and kick things off with Ken and Maximus. I believe that's 6-time selection.
I think this will be the 7th time that we've chosen Maximus, and
Okay.
this will be very short and sweet. Maximus is a company that helps the government do its job. Instead of hiring huge bureaucracies to run a lot of state government and to run pieces of the federal bureaucracy, the idea has been in the last 25, 30 years to farm the administration of various kinds of services out to private firms. And Maximus has grown up. Its most recent large contract is to help pull all the census information together, and it'll run that contract through 2021 on its way to helping get the census in a place where it can be read and used by various divisions of the federal government itself. It's been around for quite a while, and like I said, we have chosen it 6 times prior. Let's take a look to start with at the Eagle for Maximus. And I start my investing search at the Eagle most of the time. I start by looking at the blue line, and I'd like a nice boring blue line. I'd like it to be as near horizontal as possible, and I'd like it to be up, somewhere at the 90, 95, 100% range. And it looks to me like Maximus's quality has been somewhere around 95 now for the last 4.5 years. I also like to see that the par value can be something that I have a chance to make some money on. So I look at that red line, there's that simple red line kind of up and down through the graph there. And I'd like to see it near a high value, at least for the last year, 2 years or so. And in fact, that looks to me like it hasn't been that high since back in maybe July of 2017, something like that. So those two kind of visuals help me to decide this might be a stock that I want to take a look at. So then I go to one of my sources and I do some reading. I do use Value Line on a pretty regular basis, and Value Line likes the near-term possibilities for Maximus and also feels that there's some long-term possibilities if you read the analysis for the company as well. I'm looking at the projections, the 2022 to 24 projections, and I see that they're suggesting an annualized return of somewhere between 7 and 17%. That certainly is in my wheelhouse for a stock that I would consider investing in. So again, it's just something really quick that I'm looking at on my way to beginning in SSG. The next place I'll go is on that same Manifest Investing site, and I want to check real quickly where the analyst community is pegging sales growth for this company. And the investing community, the analysis seems to be somewhere in the 12-13% range for sales, with an average PE ratio of around 16. Now, I'll store those numbers in the back of my head, but they're good starting points for me to use. I'm checking the quality at the top of the page. It's a very high quality, but I knew that already from the Eagle. And the current par is around 15%, which puts it at the top of the value line projection at the moment, at least. Next slide, Mark. I'm looking now at the recent quarterly figures. This is coming right from the SSG Plus, and they certainly had a stellar quarter in September of 19. You can see the numbers for yourself, the percentage changes for yourself. And I'm going to compare the quarter that's coming up against this quarter, and I would hope that I'll end up with numbers that, while they don't have to match these very high values, I hope it's going to show good, healthy growth. The annual rates box, the percentage changes per share for revenue and for earnings are in the 10 to 11% range. And again, numbers that I'll store as I start to do my stock selection guide. Now I'll move to the tool, to the SSG Plus, and I'll look at the sales line, the pre-tax profit line, and the earnings per share line. I'm certainly getting myself nice up, straight, and parallel movement. I do know that this is basically a company that does business in the U.S., although they do have some business that they do in other English-speaking companies and in Saudi Arabia, which is kind of an outlier, but they do business in Saudi Arabia as well. And that meant that there's a little bit of a tax issue, a fairly small one in 2017, not even enough for me to see on the graph, and I'm not going to bother to make any big adjustments in the data. I like the fact that the price bars are moving roughly in line with the sales. The slope of the midpoints on the price bars are staying pretty close to what sales is. And for my money, earnings following sales is one of the keys in the better investing methodology. Next slide, Mark. Here I am now at the bottom of the SSG Plus, looking at the actual sales, earnings, and pre-tax profit values, getting a 10-year trend for those numbers. Sales at about 15 or 16%, earnings a little bit higher, pre-tax profit at about 14%. And I'm making my own judgments here. If you remember, value line was in the 10-11% particular range, and some of the things we were looking at were at the 9-10% range. I've settled on 10% for sales, and then using the preferred procedure and making some judgment calls on the preferred procedure, I get an earnings number between 11.5 and 12, which I've rounded off to 12. I notice on margin, that's the first line on the evaluation of management, I notice that margin has stayed relatively consistent, although they did have a little bit of lowering of margin from 18 to 19, going from 12.5 to 11%. I think some of that might reflect that huge acquisition that the company made, and they've seemed to have digested that acquisition quite well, and it's putting them in a place that allows them to do some of this census work. Debt certainly seems to be under control, and these return on equity numbers up around 20% or 20% plus certainly are nice and healthy. So I don't see any real worries on the evaluation of management. I summarize the SSG then by going way down to the bottom of the tool and looking at the summary box. It's coming out of buy if I use high PEs of around 22, low of around 16. Add those together, that's 38 divided by 2 is an average of 19. That's a little more aggressive than the analyst community, but still in the same ballpark. And I'm looking at a projected return of somewhere around 11.5 to maybe 15%. Again, sitting in the value line wheelhouse, sitting very close to where Manifest feels that the company is right at the moment. And I certainly think that that's nothing to sneeze at for a good, solid, medium-sized company. And so I'm going to put a 7th position of Maximus into our portfolio.
Okay, thank you, Ken.
That is my last slide. Yeah, it was pretty good. Okay.
Like we planned it. All right, so now we'll turn to Middle B, and this is a company that has been around. It's another repeat selection. Ken presented it a little while back, and we have talked about it from time to time. It's I happen to know it's a Tom Gardner Motley Fool favorite from I would say at least 20 years ago. So this is a company that has executed pretty well, and Kim is going to share the story tonight.
Yes, I went looking for a stock and I found Middleby, and as you can tell here, look at from as far back as 2009 how sales are pretty well up straight and parallel, following the line as well as earnings. So you've got consistency, and that consistency shows how management can deal with any economic environment. So next slide. Believe it or not, this company is the worldwide manufacturer of commercial kitchen equipment, residential appliances, and systems for industrial processing, packaging, and baking. They got 3 different segments: the commercial food service, premium residential, and food processing. So they have lots of leading brands, and this company grows by acquisition. And by growing by acquisition, they have to be very good at their capital allocation so that they can acquire, pay down debt, and incorporate it to get the synergies going together. If it's involving in a kitchen, they are part of it. And they're very good at making restaurants and all to be much more efficient to make sure that they have great margins. Next slide. Historically, if you want to look all the way back here to 2006, I got this off the website, you can see how this company, in whatever environment they've been in, they've done quite well with how they've been able to increase sales as well as their earnings. And if you notice on 2008 and 9, where we had a little hiccup in the market in there, they still were able to keep on growing, and that shows quality for management. Next slide. Here's a little graph that was on the website, and this is like a big eye opener. And where you were talking, Mark, about the Motley Fool people, look at what the stock price was in 1998 at 59 cents, and they only had 3 brands. By 10 years later, the stock price is $9.50. They have 23 brands, and their net sales have gone up 5-fold. But even more so when you look at 2018, that's another 10-bagger on top of that, from $9.54 to adjusted price of $101. from 3 brands they had in 1998 to 90. They've been able to grow their sales. They've been able to grow their cash flow. This is a company who's got great management, knows exactly what to do, how to do it, and those are the kind of companies I love because they are great capital allocators. And that's a biggie for me. I've got to have great capital allocators for those companies. We all want, yeah, next slide. We all want to have stocks within our portfolio that have international growth in all areas, and they're hitting it out of the park here. I saw by their PowerPoint presentation, and I did send it to Mark so he can post it, that they're opening up an area in China for some restaurant stuff, but it's worldwide and how they're doing their growth. Next slide. And here is a great slide to show how they're able to, they've added these 90 different brands and technologies, but how they've been able to merge them all together. They've been able to get the synergies together. And a lot of times, some companies who do nothing but growing by acquisitions, they get hurt by debt. And this company, when 08 and 09 came around, they really kind of thrived on it. Next slide. If you can see here what their balance sheet and their leverage is, because they've been doing this so long, you can see on how when they take on a lot of debt, because they historically like to have a $3 billion leverage with their credit facility, and then they pay it down and they do more acquisitions in there and they pay it down. And so they've been very, they're great capital allocators. That's the bottom line. And they grow by acquisition, and we've been through a recession and they went through that with flying colors. So that's another thing, because I imagine there could be another recession looming out there, and this kind of a company will, if you know that they can manage their debt, then you're feeling much better about it. Next slide. I'm sure there's got to be one or two little different food service brands that you can recognize here. And next slide. You can see where they've got, these are their premier customers. So they're in just about everything that is related to a restaurant. And what more do you say? Next slide. Well, I love the value line. And this was as of January the 10th. Mark, if you can circle over in the projections box. One of those middle things that I always like is, as a minimum, I want my annual total return to be greater than 10%, and here we have 11. On my PE, I like it to be, the trailing PE has been 16.7. Currently it's 17, but the average is 20. So that right there tells you you've got an area for capital appreciation for the stock price to go up. Where you see the solid dot on the price bars, Mark, can you circle that for me? Right there, where he's got the arrow. If you can see where those dotted lines are, that solid dot is underneath the lines, and that's showing that the stock is undervalued. You can see by the projection box, they think that the low price for out to 2022 to 24 could be 165 and a high to 250. And so it's got a lot of area to run from 109 to 165 or possibly 250. You can notice how the cash flow per share, earnings are great, but cash pays the bill. And look at how much this company is able to make their margins be nice and fat, and how they're bringing in the cha-ching into the company. Their capital spending is very low per share, and they've also, look how much they've grown that book share. In 2011, it was $9.13, but how fast they were able to double it to $20.36, and then we're going on to 5 years later, over 40. That's consistency of management. You can see where the average PE is. If right now it's at 17 and it's going to go up to 19, you've got capital appreciation. In my cheap and simple discounted cash flow is when you take the cash flow per share off the value line sheet where we had $13.30 minus the divvies, which they have none, minus the capital spending per share, which is $1. You get $12.30, and you multiply that what's in the legends box of 14. That gives you a stock price by cash flow going out 5 years of $172.20. And if you look also to what the low price could be on the stock of a 165, you could see it correlates with that by that discounted cash flow. And if the stock price gets to 172, it wouldn't be a double, but it would be a pretty healthy growth. Next slide. On the rest of the value line sheet, if you notice their shares outstanding, this is not a company who keeps adding more shares to the mix. Very consistent of what they've done, and they can't really probably lower that share price or that number of shares outstanding. So as a result, most companies, when they have a low share count, watch the stock price because it consistently kind of goes on up. And you could see how the stock price had with that. You could see how the stock price had grown with the slide we showed earlier. Look at that big fat operating margin that this company has, as big as it is. It's in the 20s. They eke out a little bit here and there. They've been doing some acquisitions, but in 2000, going out 5 years, they think it's going to grow to 25.5. Their net profit margin has gone from, in the beginning, it was like 9.5, but they're now going to think it's going to get out to 15.6. Very healthy. Yes, we know that they've got debt because that's how they do grow, by acquisition and debt. And a big thing for me personally, when I'm looking at a stock, it's got to have good return on invested capital. And I like a minimum, just a minimum of 10%. And this company is at 10% for 2020, but look at where they plan on going 5 years out, 16. So there you go there. You can see where they've got the debt. They do have some pension liabilities and some leases. In the value line sheet, it said these shares have dropped from the third quarter. We have a new CEO as of February the 16th of 2019, and that's Timothy Fitzgerald. He joined the company in 1998, so he's got a long history with this company. And he was the CFO of the company since 2003. It's 2020. So he was CFO with this company with all those acquisitions for the last 17 years. So I think he'll have a real good handle on what's going on forward in this company. As they say, the share price weakness offers a good entry point for just buying and holding. They think that the equity is trading about 15 times 2020 earnings, and if that PE is going to go all the way up to 19 from 15, that's capital appreciation. That's the stock price. There you go. And it is a B++ for financial strength. Next slide. This I got off the manifest side. You can see where we have a quality of 96, a par of 15.2, and it's a 4-star. Can't complain with any of that. Next slide. Here's the eagle. You can see where the stock price has dipped a bit and our par has gone up to over 15%. And as you can see with this, look at that. You don't get very many opportunities to get into this stock to be able to get of a par that high. Next slide. This is the price target I got off of E-Trade today. So this is where they think the 1-year price target could go to, of 153, which would be a 34% gain. So that's another thing to just consider. And I just hope you would all consider to add the stock to your portfolio, especially since we know that this stock has already, well, here's the stock chart. You can see how it is. I don't know what you can say with a company who's already been a 100-bagger, so in 20 years, so nothing bad about that. All right, then there, last but not least, you could see what the estimates are, how the PE ratio is, and you got your straight and parallel, and sales growth about 8.5, average PE of 19, so your projected annual return of 15.5. That's how we double our money every 5 years, and that's what we like. So I hope you guys would want to consider Middleby to add to your portfolio. Thank you so much.
Thanks, Kim. Yeah, this thing is quite a juggernaut. I had no idea they were acquiring that much stuff, and they apparently know how.
That's the big thing. If you have a company that grows by acquisition, the first question is, do they manage their debt? Their second question is, can they integrate it and still make money off of it? And they historically have. And this new CEO was the past CFO, and he was the CFO for the company since 2003. So that's for 17 years he was managing the money to make sure that this company did okay with those acquisitions and making good profit margin.
Mark, I'm going to take a question.
Go ahead.
Mark, I'm going to take a question from one of our directors, Charlene Hansen. Charlene, go ahead.
Oh, I'm sorry. I meant to turn that off. It was there was a point I couldn't hear anybody.
Okay, thank you, Charlene. Inadvertent, Mark.
No problem. Well, let's go ahead and switch to Cy and VMware.
All right, thank everybody. And this is a vertent as opposed to inadvertent pick for VMware. And you could see the logo that we have on the slide kind of gives you a good idea in a summary what the company does. They're an IT company. We'll talk a little bit of more detail about what they do, but primarily they are a cloud company. They started out putting data in online servers, either distant online servers or what are called internal clouds for businesses that are their own server nets, networks, and they now do virtualization of data processing as well, which is kind of cloud for processing power, is a simple way of looking at it. You can see their consistent sales and earnings growth. Next slide.
All right, before I go to the next slide, Cy, I'm going to have to ask you to raise your right hand and swear that these are not a bunch of former Cognizant Technology employees.
To my knowledge, they are not.
All right, go ahead then.
All right. As usual, I will give you a little bit of background on how I came up with the pick today. I first looked at the portfolio for various reasons. My eye kind of landed at the potential for a repeat pick on booking. Notice the quality is as good as you can get it at 90. Good stable earnings, very high financial strength, and a good potential return. So that's a company that I'm familiar with, unlike some of the other companies on here. Maximus, Charles Schwab, I have followed both of the Simulations Plus, followed those and have at one time or another featured. I don't think I've done Maximus for the roundtable, but I've written about it. But booking looked, for these companies, looked kind of the best potential. But I said, let's see what else might be out there that have a similar potential return and quality. Next slide. So I did a stock screen, and it looks like I hid part of my criteria, but you see in the lower left hand, I sought a par of at least 14%, quality of 90, financial strength of 90. You just lost the metrics, the detailed metrics, but you can see the numbers, and here are the results. Alibaba, right now, I still am wary of Chinese pigs, even though I don't think Baba does too much pork, but wasn't real keen on that one. I kind of will follow the yellow and say we'll be careful on that one. I'm looking to add a company to the portfolio. Amazon is already in the portfolio. Maximus is already in the portfolio. Of course, Booking, you can see here, comes out good in the screen. It's also in the portfolio. Walgreen, I took out because of the very low growth rate, although that is an interesting looking company potentially now, which then left me with VMware. So I said, let's take a look at VMware and see what its potential is. I like to do a quick industry study. Here is the software industry ranked by projected total return. And you can see that for this slide, the high return potential companies tend not to be high quality companies. In fact, VMware is the second highest quality company in the industry if you rank by quality. And it is, Dropbox is a excellent quality with a yellow par. And then you see Endava also, and I excluded each of those simply based, they weren't quite as high a financial strength as I was looking for, which then again led me down to VMware, which, as I mentioned, is the second highest quality company next to Microsoft in the industry, and it has a better return than Microsoft. Next slide. Here is a bit of a summary from the company for what it does. They're a global leader in cloud infrastructure, and their mission, as they stated, is to transform the way that companies do their IT business, both evolutionary, which means progressive but not radically changed, and they specialize their company, their recommendations based on customer needs. Next slide. This is kind of a conglomeration of Value Line and a few other descriptions that mentions a little bit. Again, I kind of tried to tie it together with being data cloud as well as processing power cloud. And this is a little bit more technical language for that. They provide virtualized software to aggregate servers. That's hardware. That's the data processing capability. Storage infrastructure, that is your data cloud that you're talking about, and the networks is tying it all together. And they do that to improve the efficiency of hardware, the actual computer equipment, and to help reduce capital spending and improve management of companies' IT systems. Next slide. I guess before we get to the value, I will go ahead and mention VMware was acquired by Dell Computer some time ago, perhaps 4 or 5 years ago. I didn't look it up for this presentation, and I don't recall exactly when they were acquired. If I remember my sequencing correctly, Dell put out a little bit of a public offering of VMware before the company went private, the company being Dell went private when it was still a publicly traded company. And then as part of the taking Dell Computer private, they spun off additional shares of VMware to the holders of Dell Computer. And right now, 20% of VMware is publicly traded, 80% is owned by Dell Computer. Now, here are my judgments. We've got the 3 key judgments on any stock that we have: sales growth, net margin, and PE ratio forecast 5 years from now. I went ahead and left the default manifest consensus sales growth of 12% in line. That's roughly about 10% is kind of what Value Line is projecting. Yet VMware at the time Value Line did their report had 2 acquisitions pending, Pivotal and shoot, the second one is slipping my mind. It's somebody black. It's a security company. They just closed the acquisition of Pivotal. The other acquisition is pending, and just 2 days ago they announced another acquisition. Value Line projected that those acquisitions would add a couple of percent to the top line, to the sales growth line. So that tends to also become the Value Line post-acquisition projection of 12%. The company is projecting 12.5% for this year. Net margin, I was a little more conservative than the consensus. Consensus is projecting a significant increase in the margin. I was a little more modest in my margin increase projection, going with 27, which is a bit above the current, but not as great as some of the analysts are projecting. PE ratio, I'm a little higher than manifest consensus, but not a whole lot. And that gives a projected return of 13.2% versus the manifest consensus return of 15.2. So a very healthy potential return. And then again, as Ken closed his report, I also like to look at the Chronicle, and you can see here until you have to go back to 2015 to see as high a potential return for VMware as it's potentially selling at right now. So I am adding $1,000 of VMware to the portfolio.
Okay, thank you, Cy. And we'll be checking the rosters of employees to see if they're consulting heritage. Got to ferret out those Cognizant guys. I'm going to step through quickly to save Hugh enough time. We've got Hugh joining us here tonight, and he's going to be presenting one of his healthcare-related stocks, I think. So let's leave plenty of time for that. We are going to start a new feature at Manifest where we basically continuously publish only companies which have 100 Manifest rank, and that means that their return forecast and their quality basically combine to form a fairly powerful combination. Kind of emulates something that Tom and Dave Gardner do with their stock advisor, where they talk about they've talked about that would still be current candidates for accumulation. You know, good stock studies for the current time frame. And you see a number of stocks that we've talked about here tonight and in recent months on this list, and they are the only stocks that actually fit that criteria as of tonight. So we know that in terms of going shopping among this list, we know that these 2 categories are good. We noticed that all of these 1-year returns are pretty good. That's not really a major factor for me. We noticed that the analyst consensus estimates as to whether or not these prices are attractive, they're in pretty much full agreement on those also. So that all of these are deemed to be basically on sale according to the analyst consensus. And so I'm going to turn to probably what I'm finding to be 2 of the more important characteristics for buying stocks. The first has to do with that thing we've talked about for the last year, the owner's projected return on capital. And we love for that number to be a typical number is down around 8 or 9%. We love to see numbers in the 15 to 20 range. So I'm seeing this number of 22 for Skechers, and that just kind of draws my eye. And then in combination with a relative strength index, hopefully below 30, in the 20s, it's just a wonderful thing. What that is basically saying is that stock has been punished by the Wall Street rhinos, and the stock price is down against a historic trend. So you have this company, which basically has high potential returns on any capital invested into it, and it's been punished of late. It looks pretty good across the board. Notice that we talked about Charles Schwab in the green room. That one also makes the list here. So Skechers, again, no stranger. It's a repeat selection. They are the third largest footwear company, recreational footwear company behind Nike and Adidas. And I think many people in the audience, including me, own some Skechers. Here's a look at how the company has done over the last couple of years. Some of you may remember that we selected Skechers back at this moment of time, about 18 months ago, to correspond with this relative strength index dip. And it's actually outperformed the market quite handsomely over the last 18 months. And despite skepticism about buying this type of a company, we know it's going to be kind of a rocky road for a company like this, but catch it at the right time, and you can have fun with it. Notice that the relative strength index has indeed dipped down to below 30. It's worth an accumulation study at that point. Part of the problem with the company is they do a lot of business in China. They do 60% of their manufacturing there, and that causes angst when it comes to the tariffs and shipping product to the United States. But lo and behold, much of that 60% stays over there. So the tariff issue is not an issue. That is not fully reflected in the company's stock price, in my opinion. Tariff stuff is kind of hammered away. Like many American companies that do have operations in China, they are actively seeking venues. And you can see some of the names listed there at the bottom. Southeast Asia, probably including Vietnam, but other countries around the world to be not so dependent on China. And yeah, that's a tough management task, but certainly not neutral for them and something that they have done. They've got a lot of potential for continuing growth and improving profitability, and they certainly have been delivering that over the last several years, as we'll see here. There is Skechers. They have had, like many footwear type companies, they have their moment in their life cycle history. That particular moment came about 10 years ago when sales dipped pretty nastily and earnings fell off the page, and that gives a lot of us the heebie-jeebies. But look at the lines since then, and they've been expanding rapidly, expanding profitability. You can see the profitability curve down here. Again, this is basically Section 2A, flavor of Section 2A just graphically, and that is a very nice trend, one that is certainly feasible going forward. Their PEs have stabilized in the teens. So we're talking about a $5 billion company, a lot of room to grow. They're, like we said, they're third in line. Growth forecast of about 10%. That's the slope of the red line over here. Projected net margins of 18.5. There's actually some bad numbers on here. I apologize for that. Yeah, this is a bad number, so I need to fix that when I actually post the presentation. But we're basically looking at a long-term return forecast in the 15 to 20% range. And again, we see that the buying opportunity has come home to roost right here with the relative strength index below 30, very little debt, and a fairly decent long-term projection. I'm going to go ahead and accumulate another $1,000 into Skechers to hopefully hit the road running. All right, so with that, let's go ahead and give you the balance of our time. He wants some thoughts to share on his selection for this evening, which I believe is Gilead Sciences. Is that correct, Hugh?
Yeah, that is correct.
Take us away.
I mean, in the past, I tend to look at what I've bought before, and all else been equal, I just buy what I already own. Kind of lazy that way, but it's just an easier thing to do. Well, this time I was looking through companies near their 52-week low, or in this case near a 3-year low, in fact a 5-year low. Gilead has popped up for a while, and I've always liked the company, worked with it and everything. But I've decided now I think I'll start buying it. And if the price stays depressed for another year, that's fine. By me, I will just buy it. So moving on to the next slide. Everyone knows Gilead is a pharmaceutical company based in the Northern California, south of the city of San Francisco in the Bay. It was founded in 1987, went public in 1992. It's now worth over 80 billion, and it's a NASDAQ 100 company. It's a research-based company. It also acquires companies to add to its drug portfolio, but it's really focused on three areas, maybe four, but certainly three. Antiviral work in hepatitis C and HIV, liver disease, which obviously overlaps with hepatitis C, and B as well, and oncology, and it looks at respiratory diseases as well. So if we move on a little bit, these are its marketed drugs, and it has a very strong portfolio of novel therapies and generates lots of revenue as a result. Revenue has been in decline, actually, but I'll come back to that in a second. But the big areas are HIV, hepatitis C, liver disease, put the hepatitis C other liver disease on this list, and oncology as well, with the acquisition of a company called Kite. So we move on to slide 49. We can just look at the pipeline. We'll skip through these slides pretty aggressively, but I just want to dwell on one drug in the HIV therapy, which has the code name of GS6207. It has a novel approach to attacking HIV, and I'll talk about that at the end and why this could actually be quite a big drug if it successfully goes through the clinic. That's the big if. But certainly the approach that Gilead's taken, if this drug doesn't work, is likely to be replicated in other drugs or other attempts to attack the virus, not only HIV, but other viruses too, including the flu. Let's keep moving. Again, we're now looking at liver disease, and if we skip to the next slide and the one after that, you'll see that it has a lot of offerings in liver disease at various stages in the approval process, or the development process from phase 1 all the way through late phase 3. And then finally, in oncology, many of the drugs here is a drug, an asset that is acquired from Kite 2 years ago, where it spent $11 billion. And but it has some homegrown efforts as well. Maybe we won't see that on the next slide. I think they're Kite. Oh, well, we do. We see the an antibody, which has a GS number, and a PD-L1, which is a small molecule inhibitor targeting solid tumors. High bar right there. And then the final slide, I think, just lists the end of the oncology. Oh, more pipeline. And this is mainly small molecule. I've highlighted a drug that it's partnered with a company called Galapagos, which is a Dutch-based company. This should, it's a JAK1 inhibitor. It's a kinase inhibitor, is a big thing right now, a big target, JAK1 and JAK2. So you see a lot of small molecules targeting that enzyme. This one should go through the approval process in pretty short order, soon, I mean, and we'll see how well it does on the other end of that. And then I think the next slide there's a couple more left. We'll see Galapagos again, 1960, and a small molecule inhibitor for ulcerative colitis from Gilead, discovered in-house. And then moving on, we see final end of the inflammation respiratory disease slide. And it has one other drug, so it's looking to attack Ebola. It's a very strong antiviral company, and it wouldn't surprise me if down the road it goes after flu as well. So let's move on. Well, the thing about Gilead, if you look at the stock price for the last 5 years, it's just been horrible. It started off with a high closing in close to 120 bucks a share, and now it's down under 60 at points, or at least it dipped in that region, and it really hasn't done much in the last 12 months. There were good times on slide 58. For those of you who were buying it in the 1990s, and I know there are probably some here listening now that bought it at an adjusted price of less than $1 a share, well, you've done quite well over time. But the last couple of years have been very painful, particularly, as I said, on the next slide, you'll see the last 12 months, where this stock price has just been throwing a hissy fit. We'll see that on slide 59. Yes, it's like a lunar surface or something like that. Not really done well at all, moving between 60 and 70 bucks a share. It's close to 64 today. Now, the reason for this is very, very simple. It has a lot of products in the market. It has a really enviable pipeline. It has extremely few employees compared to other pharmaceutical companies. It's a highly productive company. The output per employee is the highest in the industry. So why has the stock price tanked? And has it and been tanking for the last 5 or so years? Well, the story is that in 2011, it bought a New Jersey-based company called Pharmacet, which had a hepatitis C asset. At the time, everyone agreed that Gilead overpaid for this company because the drug really had only emerged from phase 1 or had strong phase 1 and a little bit of phase 2 data, but they paid $11 billion for this hope. And it paid off because 2 or 3 years later, the drug got approved by the FDA, and then it got approved as a combination therapy the following year. And they actually found a cure for hepatitis. About 90% of people who received it had their hepatitis wiped out of the system, which is remarkable. But if we move forward, you can see that one of the challenges it faced was the list price. No one paid this. Insurance companies covered it. And even they didn't pay the $84,000 or $1,000 a day for the 8 to 10 week course of treatment, but there was resistance to that pricing. And one of the challenges, and I'll talk about this Vertex experience in a minute, is hepatitis C has a very long gestation period. You can get the virus in your system, and it can hang around there for 30 years and not show any symptoms at all. So in that regard, patients can be warehoused. It's not critical that they be put on a therapy straight away. And then, of course, when other drugs came on the market, the patient population declined, the volume of the drug being sold was decimated, and revenues followed suit, as did the stock price. So we skip to the next slide. We can see a little bit of foreshadowing here because Vertex actually had the very first blockbuster in the hepatitis C space. They launched the drug in May of 2011. Now, it was about 6 months later that Pharmacet, the company that Gilead acquired and got that blockbuster drug from, December of 2011, or maybe it was November, is when they released clinical results showing that it cleared the drug out of the system, which Vertex was not able to do, but it was certainly significantly better than the treatments that were already on the market. Vertex, when they launched it, had the fastest launch of any drug in history. It reached $1 billion in sales in the first 6 months in the market and closed the year at 1.56. It was staggering. It even beat Celebrex by, $10 million, but a win is a win. But it was spectacular, but so was the fall. The trouble started almost immediately at the end of the year when Pharmacet released its clinical results. A lot of physicians stopped prescribing the Vertex drug because they figured, well, there's an even better therapy coming down the road. There's no urgency to treat patients right now because they're not exhibiting symptoms. And if this hepatitis C drug really clears the virus out of the body, we should hold off and wait for that drug to come on the market. So within 3 years after its launch, its sales essentially went to zero from the $1.5 billion, and it was withdrawn from the market. Now, I say foreshadowing because Gilead didn't quite follow that path, but it was something similar. Their patients got warehoused when companies like AbbVie and some competitors in the space announced that they had drugs and the drugs work well, and they would likely be cheaper. So physicians held off prescribing and sales dropped as a result. So we move to slide 64. The one thing I'm very fond of saying is to keep in mind that the industry I work in, the pharmaceutical industry, it's the only business that's in the business of trying to put itself out of business. And that's what Gilead did. Gilead came up with a cure. Cures are costly because people don't want to pay for them. They want them to be free. And a good example of that is antibiotics, which have a remarkable effect on course of health of an individual, but really people do not expect to have to pay for them or pay very much. And that actually deters research in a very, very critical area. But it hasn't deterred Gilead. They're going down the road looking for cures for other viral diseases. And it looks like they may actually come across one. Let's skip to the next slide. Things to watch. And one of the reasons that I haven't adorned this presentation with a lot of the financials of the company is to some extent they're kind of meaningless. Very aggressively offensive thing to say in this forum. But the fact of the matter is that yes, they demonstrate that Gilead is able to buy companies, able to integrate them, and able to convert nascent drugs into marketed drugs very successfully. It's able to manage debt, it's able to grow its revenues, it's able to manage a sales force, it's able to control R&D expense, it's able to do all of those things, and certainly the last 20 years of financial information shows that. The key thing we want to know is what is it going to do for the future? And in this regard, the past is not a really good guide, because what has happened in the last 5 years is kind of exceptional, and what will happen in the next 5 years will to a large extent depend on the drugs that are in the clinic right now, and if they are successful in the clinic and gain approval, they will be the revenue generators in 3, 4, 5, 6 years. And the two areas to watch are the purchase of Kite, paid, I believe, $11 billion for that company. And it's a whole different area because instead of looking at small molecules, the equivalent of aspirin, it's looking at biological molecules and actually specifically tailored biological molecules for a patient. And then back to its old small molecule roots, it's looking at 6207, talked about earlier. So if we move along, Kite is Gilead's move into the large molecule space. The drug is what's called CAR-T. You might have heard of CAR-T in terms of all of these oncology drugs that are immunotherapies. That's very hot right now. What it does is it takes the body, a certain type of the body's T cell, which is an antibody that fights infections. It extracts them out of the body and it does genetic manipulation on the genetic information in that cell, so that the T cell, instead of going after whatever it was that it thought it should go after, it actually binds to something on a cancer cell, a target that is known to exist on cancer cells and only cancer cells. Then you grow multiple copies of that modified T cell in a lab, and then you reintroduce them into the human body. And for years, people have been trying to work out the exact kind of dose. They've been trying to make sure that the body doesn't overreact to this novel T cell and go nuts, signaling to the body, hey guys, looks like there's a powerful T cell in town, everyone charge and attack. That can result in death of the patient. They seem to have controlled all of that, and in many cases, they've been able to eradicate some cancers completely from the body. It's remarkable what they can do. And these are often blood-borne cancers, leukemias and the like. Solid tumors are still a bit of a challenge, but people are starting down that direction. So this is a very aggressive move, high risk for Gilead. Their lead drug was approved. Sales flattened in the last quarter. It will be interesting to see in a few weeks how they did in the last quarter of 2019. But this is an area going forward that will be very, very important. And just like the hepatitis C drug, it is a cure. Once those CAR T cells are going around the body circulating, they're there forever. So that cancer, if it's cured, won't come back, at least in its given form. Other things can happen. And then if we skip along to the next slide, the reason I think this is a very novel approach is that a virus has a protein code. It wears a protein code that really doesn't change a lot. The genetic information, it should not have an apostrophe. I apologize for that. That drives me nuts. That's 20 years of Catholic school down the drain. But the protein code protects the genetic information inside the virus, and that genetic information changes a lot. Oh, you're going to get rid of it? Thank you. You can breathe.
Yeah, I went to a Catholic school too.
Yeah. Okay. Good. Feel good. Can put my hands on the table again. So the genetic, you've heard this about the flu, that it morphs into a slightly different variety very rapidly. And so it's always a chase to go after the latest variant of a given virus. Well, what Gilead is doing with this drug, which is quite novel, is they've said, well, instead of targeting the proteins that are produced by this genetic information, why don't we actually go after the protein coat that surrounds the core of the virus and see if we can disrupt that? And so far, it's actually looking quite good. And this approach works, and it doesn't harm other protein surfaces in the body surrounding good things that we all know about, then, and we need for our survival, then it may be a way to circumvent the fact that viruses can mutate rather rapidly, and that you might be able to wipe them out completely in the body. So it could be applied to the flu, common cold, or even the coronavirus, which is circulating around the planet right now. So it will be very interesting. I've been following this drug since it was first published in preclinical work about 3 years ago.
following it for a while. It's successfully gone through phase 1. Phase 2B is going to be the critical one, which is coming up. But let's see what happens, and certainly keep an eye on this one. If it works, analysts are projecting it could be a $20 billion drug. So the past financial information here isn't a great indicator of what's going to happen in the future. Unfortunately, we're flying blind very often. The pharma industry is certainly with Gilead in its current form. It's demonstrated, as I said, the ability to acquire and integrate other companies. So far, it's doing quite well with Kite, and it shows an innate ability to develop novel therapies in-house, as that GS6207 demonstrates. But the future for Gilead certainly rests on CAR-T and this novel antiviral therapy that it's developing. But I think CAR-T is probably going to be the more critical one in the short run. That's the one to watch. So that's it. That's why I want to buy Gilead. And, I project that I'll be buying it very regularly unless it does something bad to me, which is increase in price suddenly. So we skip along. I just wanted to mention that nothing really has happened with Ardelyx. It's currently about $7.40-ish. I would imagine that this company should be worth between 15 and 20 if it's acquired, but so far nobody has stepped forward to buy it. If it skips much above 10 or 11, and it's clear that no one is going to jump the gun and buy it, I might just sell my position in that company, but we'll see. But yeah, so there's no real news that I found out about Ardelyx recently.
Okay.
So with that, I apologize for the apostrophe again.
And we'll let it slide.
Yeah, and that's it from me.
I think I'm going to start a pool, and we're going to start a pool on how many Groundhog participants put Ardelyx or Gilead in their portfolios. All right.
Get into long-term investment.
And we are ready for the poll.
I do them sometimes.
And the poll is open. All you need to do, folks, is sit there with your mouse or your finger or however you communicate with your computer or your tablet or your phone, and put a tick mark next to the company you would like to purchase. This would be an extra $1,000 then going into the portfolio. We have a really nice size audience tonight, and we have 80% of you voting. Let's give you another maybe 5 or 6 seconds. Let's try to boost that to 90. Doesn't cost you anything, folks. Just take and vote for one of the 5 companies. I'm counting down in my head. We're at 86%, 87% voting now, 88% voting. And I'm going to close the poll and share the results. And it looks like Middle B was a runaway.
Oh,
They liked the idea of the restaurant equipment. That was Kim's stock. Pretty close on the other 4. So we will add an extra holding of Middleby to the portfolio. I'm going to hide this now, Mark, and
Okay.
I think show folks where we're going to be in the near future. There we go.
Yeah, and I think our next roundtable will be on February 25th. That's the last Thursday in February. That is our awards ceremony, and about the Golden Knights. And that one should be a blast. We had quite an exceptional year, and he was already had to add on to his trophy case. I suspect he needs to get the wheelbarrow out again, apostrophe or not. But
All right.
Ken and I are both going to be in St. Louis and Philadelphia in April on the dates shown, and currently scheduled to be at the NAIC National Convention in Dallas in May. And Ken, I believe you're visiting Columbia, South Carolina in June. There are a few other dates that we're firming up or unfirming. on the schedule, but we'll be updating this list here shortly.
Okay, we'd like to thank everybody for coming. I think I'm going to give Mark the opportunity to close down the program, but stick around if you want some of the questions answered that you've asked during the session, and we'll try to get to those right now. I do have a